In this presentation, we will take a look at multiple choice questions related to managerial accounting decisions and scenarios, going through those questions and then practicing test taking skills with them. First question, 20,000 units now. The variable production costs per unit $2 and total fixed costs $15,000. Sales price $10, or we can process further for an additional cost of $30,000. Processing provides $17,000A, $3,000B, which can be sold for $13 and $11 per unit, respectively. The incremental income to process further is. So then we have the numbers here. Now again, if you were to look at a problem like this, you might first say, hey, there's going to be numbers in the question. Are there numbers in the answers? There are. Therefore, it's probably some type of calculation type question. Let's look at the final sentence to see what we'll be looking for before we go through the question. Would be a way that could save some time. So if the final sentence says, the incremental income to process further. Key term here, all we need to see is process further with this kind of problem after we've seen a few of these, and we're going to say, this is a process further problem. We should basically know in our mind and say, okay, well, that means that we're going to have some kind of thing that we're producing, that we produce it to this point, and then we could process it further and make it better and sell it for a higher price, but it's going to cost us to process further. So that's going to be our scenario that we're looking for. We're looking for the incremental income. So that's going to be basically the increment. We're going to have to consider then the income, and that means in essence net income. Note that when you talk about managerial accounting, we're looking for basically net income. So it's kind of a tricky term. We're looking for revenues and expenses, the changes of revenue and expenses, the incremental income type of calculation here. Given that information, then we have the 20,000 units now, the variable production cost per unit $2 and fixed cost $15,000. This is what it costs to get to the 20,000 units now before the split, before we decide whether to process further or not. And therefore, with regards to the question of processing further or not, which usually is the question we're asking, this is irrelevant, right? That's going to be irrelevant data. We're looking for the incremental income, those incomes that will differ between the two, revenue and expenses that will differ between our two options. So we're going to go through that with keeping that in mind. So let's break out our information. We're going to list out the two options. So we're thinking about this point in time. We've got the two options we can do. We can either sell them as is, or we can process further. So if we go through this, we're going to say, here's the costs up to now, once again, irrelevant to our decision-making point at this point forward. We're going to say that the sales price as of now, we could sell them for a sales price of $10, and there's going to be, the units that we have are 20,000 units. So I'll say units at this point are 20,000. We're going to say, all right, we multiply that out, this times this. That's going to be our revenue. So, and notice revenue is a different term here than income, because usually managerial accounting will kind of shorten income to be like the net income. So notice there's no added costs here to do this, because we're talking about this point forward. These costs that happened in the past, they're not relevant to our incremental cost, the decision-making point at this time. So we got the sales price, and then we could process further, which costs another $30,000. So to process further, we would have two products that we're going to end up with. Yeah, and I think this is what they're trying to say here, right? We could sell these 20,000, or we can process further to product A and B. So A and B product, and we're going to have 17,000 of A. We're going to have 3,000 of B. We can sell them for $13 A and $11B, or 13 and 11 respectively. If we then multiply those out, we're going to say the 17 times the 13, it's going to give us the 221,000, and the 3,000 times the 11 gives us the 33,000. Going to go ahead and underline this just for our formatting purposes. Home tab, font, underline. If we then total these up to process further, we'll say summing these up, that we're going to take the 221 and the 33. That's going to give us the 254. The difference, the incremental revenue here, is going to be the 254 to process further minus the 200,000. Now we have to consider the costs, the incremental costs. So the added costs, so the incremental costs is going to be 0 here, because again, these costs already happened. They're under both scenarios. There's no added costs at this split point if we just sell them as is as of now. The added costs over here, however, are going to be another 30,000. 30,000 cost here. Difference being 30,000 minus 0, or 30,000. So if we were to say, okay, if we stopped where we're at here, we're at 200,000. If we process further, we're at the 224, and the difference being 24,000. So here's where we would be if we were just to sell them now. Here's us processing them further, and here's going to be the difference at the 24,000. This is the one we're looking for because we're looking for the incremental income. And again, you might think that that should be the revenue line, the top line, but managerial accounting kind of twists the terms around a little bit. If it was financial accounting, it probably would typically be, and we would call the bottom line net income. Managerial accounting oftentimes will use the terminology just to kind of shorten things up, I would assume would be the reasoning. The bottom line number being income, top line number being sales, oftentimes because we're talking about selling units, or they might say revenue. So we're looking for the item C, final answer 24,000. Next question. We received a special one-time order for 2,000 units at $5 per unit. We produce and sell 8,000 units at $10 each. We are not producing at capacity. Production costs for these units are $8 per unit, which includes $3 variable cost. To produce the special order, a new machine needs to be purchased at a cost of $1,500 with a zero salvage value. Management expects no other charges in costs as a result of the additional production. Should we accept? Okay, so A says no because there's no added incremental income. It would be more complex to accept. B says no because incremental costs exceed incremental revenue. C says yes because incremental revenue exceeds incremental cost. D says yes because incremental cost exceeds incremental revenue. And E says no because the increment revenue is too low. All right, so let's go through this again. If you see a problem like this, you'd say, okay, there's numbers in the question. That means it might be a calculation. I don't see any numbers in the answer, so maybe it's going to be a non-calculation problem. Let's look at the final sentence. Management expects, or the final sentence is, should we accept? All right, so we're accepting something. Let's go to the second to last sentence. Management expects no other changes in cost as a result of the additional production. So again, no additional production, so that kind of gives us a hint of what we have here. It's not the most expressive or explicit final sentence to give us the kind of a recap of what we're doing, but it does say that should we accept an offer or not. So I'm guessing that given the questions are we looking at a special offer type problem? Common managerial accounting question. We have a special one-time offer. Should we accept it or not? And the key factor in this type of question is whether or not it's going to be the variable costs versus the fixed costs again. So we're always looking for, it's always going to be a situation where it would say, hey, if I calculate, it looks like it could be a decent offer, but I can't really tell unless I take into consideration the fact that some of the costs are applied and some of the costs are, in other words, won't go away if we were to accept or not accept the offer. So let's break this one down using Excel. So if we break this down in Excel, we go through this, say we're going to receive a special one-time order for 2,000 units at $5 per unit. So they want to basically buy something, a special order. We expect the $5 to be less than what we usually sell for. And normally we would say, well, no, we're not going to do that in normal kind of production because there's a reason we set the sales price for what the sales price is. However, if it's a one-off deal and it doesn't affect our other kind of sales, it might be a case where it would be profitable to take it to do that. So we produce and sell 8,000 units at $10. So normally we sell them for $10, right? So that's a lot higher than the 5. We are not producing at capacity. So we're not having any problem with us. We can make more units, in other words, without us having to add added fixed costs because we're not at capacity. So we're able to do it, in other words. Production costs for these units are $8 per unit. So the costs are even higher than they're asking for. So you might say, well, maybe if it's a special offer, if they clear the costs, even though we sell them for $10, they have to at least clear the costs, don't they? And we're going to say, well, possibly not, right? Possibly not, because sometimes these costs are applied out in terms of fixed and variable. So we applied some costs to them. some costs that would not go away even if we were to accept the special offer. So we have to break out the variable and fixed portion to really consider as to whether our financial statements would be higher if we were to accept the offer. So which includes $3 of variable. So if we were to consider this, then we're saying, okay, the total cost is $8, but only 3 of those are variable costs. So basically only 3 of these $8 costs are variable. And that's going to be less than the $5 offer. And that's going to be really the relevant data. That's all we really need to break this out if they're only asking us for whether we should accept the offer or not, right? Because from a financial perspective, we are going to be better off because only $3 of this is going to be a variable cost. The rest of it, we're assuming its overhead wouldn't go away either way if we accept or decline the offer. So the relevant cost then is going to be the $3. It's less than the offer price of $5. So if this is a one-off offer, it doesn't affect our other market conditions and whatnot, then it would increase our net profit to basically accept it. So we're going to say yes because incremental revenue exceeds incremental costs, which is C.